January 23rd, 2026. The day the financial world stopped pretending. Silver didn't just cross $100, it shattered through it at 99.16 in New York. But here's what they're not telling you. While Wall Street celebrated breaking triple digits, Shanghai closed at 111.66, a $12 gap in the same metal on the same day. This isn't a rally, this is a rupture. And the banksters who've controlled this market for 40 years are staring at mathematical insolvency. But there's something even more terrifying happening right now. Something that hasn't occurred in 50 years. Gold hitting all-time highs, silver breaking $100, and the stock market rising with them. That's impossible. Unless, welcome to John Analyst, if you've been in the business world long enough to remember when a handshake meant something, when contracts were honored, and when currency actually held its value, then you understand why what I'm about to show you matters. I don't ask for much. But if this analysis serves you well, do me the courtesy of pressing that subscribe button. We're building something here for serious people who want serious answers. And before we dive in, drop a comment below. Tell me where you're watching this from. New York, London, Singapore, Mumbai. Because what's happening in silver right now, it's not just an American story, it's global, and you deserve to know the truth. Let's begin. There are moments in financial history that divide time itself, before and after. January 23rd, 2026 is one of those moments. On this day, at precisely 9:47 a.m. Eastern Standard Time, the GlobeX electronic trading platform recorded a price that Wall Street has spent 4 decades trying to prevent. Silver touched 99.16 per ounce, not $98.50, not 98 to 99, but 99.16. And in that single tick, a 50-year fortress collapsed. This wasn't a gradual climb. This wasn't investor optimism or industrial demand creating upward pressure. This was a violent breach, the kind that happens when defenders run out of ammunition, when the walls can no longer hold, when mathematical reality overpowers institutional will. For weeks leading up to this moment, the pattern was unmistakable. Every time silver approached $95, massive sell orders appeared. Paper contracts flooded the market. Margin requirements were suddenly raised. Financial media published coordinated pieces questioning silver's fundamentals. The message was clear. $95 is the line. Do not cross. But the line failed. So they moved it to $96, then $97, then $98. Each new defense weaker than the last. Each barrier crumbling faster than the previous one. By January 22nd, the institutional short sellers, the banksters who have manipulated this market since the Hunt brothers were crushed in 1980, were throwing everything they had at the 98 level. Futures contracts, coordinated selling, algorithmic suppression. But on January 23rd, the market simply walked through them like they weren't even there. Now, let's be precise about what $99.16 actually means. This isn't just a psychological milestone. This is a mathematical inflection point. When silver trades below $50, a short seller with sufficient capital can survive. At $70, the position becomes uncomfortable but manageable. At $85, margin calls begin, but liquidity can cover them. But at $99, at $99, the leverage ratios flip. The margin debt required to maintain short positions exceeds the total capital reserves of mid-tier financial institutions. This is what analysts call mathematical insolvency. The point where the loss isn't theoretical anymore. It's existential. For every dollar, silver rises above $100. Certain players in this market lose billions. Not millions. Billions. And they cannot print their way out because the losses are denominated in physical metal they must deliver. But here's where this story takes a turn that should concern every strategic thinker watching. While New York was barely crossing $99, Shanghai had already kicked the door down entirely. The Shanghai Gold Exchange, the largest physical precious metals exchange in the world, closed its session at $111.66 per ounce. Let that number settle. New York, $99.16. Shanghai, $111.66. The same metal, the same day. A gap of $12.50 per ounce. In percentage terms, that's a 12.6% premium. In a properly functioning global market, that gap should exist for milliseconds. High-frequency trading algorithms should instantly buy in New York and sell in Shanghai until the prices converge. But the gap isn't closing, it's widening. Shanghai's single-session gain was 8.5%. In precious metals terms, that's not a move, that's a stampede. The price in yuan terms hit 24.97 per kilogram. And here's the critical insight that most analysts are missing. This premium isn't random, it's a vacuum. A tractor beam pulling every available ounce of physical silver eastward. Every refinery in Switzerland, every vault in London, every mining operation in Mexico is looking at these two prices and making a simple calculation. shipped to New York for 99 or shipped to Shanghai for 111. The metal flows to the highest bidder, always. And right now, the highest bidder is 7,000 miles away from Wall Street. This creates a strategic problem for the Western banking system that has no solution. They can print unlimited paper contracts. They can manipulate futures markets. They can coordinate media narratives. But they cannot stop the physical metal from leaving. And without physical inventory to back the paper promises, the entire structure collapses. The banksters defending $99 weren't just fighting a price level. They were fighting the physics of global arbitrage. And physics doesn't negotiate. On January 23, 2026, their arms finally gave out. The barrier is broken. The fortress has fallen. But if you think this is just about silver hitting $100, you're looking at the symptom, not the disease. Because while silver was breaching triple digits, something far more dangerous was happening in the broader market. Something that violates every rule of traditional economics. Something that hasn't occurred in half a century. And it's flashing a warning signal that most investors don't even know how to read. There's a dashboard inside every major trading floor in the world. Not the flashy screens you see in movies, not the ones with spinning logos and colorful charts. This dashboard is simple. 2 indicators, 2 categories, risk and safety. For the entire history of modern finance, these 2 indicators move in opposite directions. When one rises, the other falls. When fear enters the market, money flows from stocks to gold. When confidence returns, money flows from gold to stocks. This isn't theory. This is the fundamental law of capital allocation, the seesaw principle, the yin and yang of portfolio construction. Every institutional investor, every hedge fund manager, every wealth advisor builds their strategy around this inverse relationship. But on January 23, 2026, the seesaw snapped in half. Both sides went up at the exact same time. And if you understand what that means, you should be making decisions right now. Let me show you what appeared on screens across the financial world this morning. Gold, $4,835 per ounce. Not just high, all-time high. A level never reached in the 5,000-year history of gold as money. Silver, $99.16 and climbing. Breaking through a psychological and mathematical barrier that has held for decades. These are the fear trades, the assets you buy when you think the system is breaking, the ultimate safe havens. Now look at the other side of the screen. S&P 500, record highs. NASDAQ, positive territory. Dow Jones, climbing. These are the confidence trades, the assets you buy when you believe the economy is strong, when corporate profits are growing, when the future looks bright. So let me ask you a simple question. How can both be true? How can investors simultaneously believe the economy is booming and believe the economy is collapsing? How can the same dollar flow into both the panic button and the prosperity button at the exact same moment? The answer is terrifying in its simplicity. Neither is true. The assets aren't moving. The ground beneath them is sinking. Imagine you're standing in an elevator. The floor display shows numbers climbing. Floor 10, floor 20, floor 50, floor 100. You feel like you're going up, but you're not. The building around you is collapsing. The elevator shaft is falling. The numbers are rising, but you're descending into a void. That's what's happening in the global economy right now. Stock prices aren't rising because companies are more productive. They're rising because the measuring stick, the dollar, is shrinking. Gold isn't rising because it's suddenly more useful. It's rising because it's the only constant in a world where every variable is being manipulated. This phenomenon has a name. Austrian economist Ludwig von Mises called it the crack-up boom, the terminal phase of currency collapse. The moment when the public realizes that paper money itself is dying and begins fleeing into anything tangible. Stocks, real estate, commodities, art, anything except cash. Because cash is the one thing guaranteed to lose value. We've seen this pattern before. Weimar Germany in 1923. The stock market reached absurd heights measured in marks. People felt wealthy. They watched their portfolios multiply. But when they went to buy bread, the bread cost more than their entire month's gains. The stock market went to the moon while people starved in the streets. Zimbabwe in 2008. The Harare Stock Exchange became the best performing market in the world. In nominal terms, investors were geniuses. In real terms, they were being obliterated. A 50% gain in stocks meant nothing when food costs rose 100%. And now, New York, 2026. The pattern is repeating, but this time it's happening in the world's reserve currency, the currency that denominates global trade, the currency that backs the entire international financial system. When the German mark collapsed, it was a national tragedy. When the Zimbabwean dollar collapsed, it was a regional crisis. When the US dollar collapses, it's a global extinction event. And make no mistake, what you're witnessing right now is the early stage of that collapse. The simultaneous rise of stocks and gold isn't a sign of economic strength. It's a sign of monetary desperation. The Federal Reserve has lost control, not of interest rates, not of inflation. They've lost control of perception itself. The market no longer believes that dollars represent value. So every dollar created, every trillion printed to pay government interest, every quantitative easing program disguised as liquidity management flows immediately out of cash and into assets. Any asset. All assets. This is the liquidity tsunami. A wall of newly created currency crashing through the economy, lifting every boat in the harbor regardless of whether that boat is seaworthy. Your 401k balance might be hitting all-time highs. Your stock portfolio might be showing green. Your real estate holdings might be appreciating. But here's the question. No one is asking. Can you afford groceries? Can you afford fuel? Can you afford healthcare? Because if your portfolio rises 10%, but your cost of living rises 20%, you're not getting richer. You're getting poorer while feeling wealthy. That's the trap. That's the seduction of the crack-up boom. It makes you feel like a genius investor right up until the moment you try to convert those paper gains into real goods. And by then, it's too late. The window is closed. The currency has collapsed. And the only people left holding value are the ones who recognize the impossible signal for what it was. A warning, not a celebration. But here's what makes this situation even more complex. Even more unprecedented. The impossible signal isn't happening in a vacuum. It's happening while central banks across the world are engaged in the largest coordinated money printing operation in human history. And that flood of liquidity, that ocean of newly created currency, is the fuel feeding this fire. Every crime needs a weapon. Every fire needs fuel. Every flood needs a source. We've identified the crime scene. We've documented the impossible signal. Stocks and gold rising in perfect synchronization. We've watched silver shatter $90 while the S&P 500 celebrates record highs. But we haven't yet identified the weapon. And until you understand the weapon, you cannot protect yourself from what's coming next. The weapon isn't complex. It's not hidden in offshore accounts or encrypted algorithms. It's sitting in plain sight, in the basement of every central bank on this planet. The weapon is the printing press, and it's running at full capacity, 24 hours a day, 7 days a week, without pause, without oversight, without limit. Let me take you inside the machine, because what's happening right now isn't a market rally, it's a drowning. The global economy is being flooded with so much newly created currency that every price, stocks, houses, gold, silver, even used cars, is rising simultaneously. Not because these things are becoming more valuable. A house is still just wood and concrete. A stock is still just a fractional claim on a company. An ounce of silver is still just 47 protons and 61 neutrons. The physical objects haven't changed. But the ruler you're using to measure them, the currency, is shrinking. Every hour, every minute, every second. And the shrinkage is accelerating. Let's start in the East. China, the world's largest consumer of physical silver, the engine pulling the Shanghai Gold Exchange to 111.66. Right now, China's M2 money supply, the total amount of cash and liquid deposits circulating in their economy, has just hit an all-time high. Not a slow climb, a vertical spike. Trillions of yuan created in a matter of months. Why? Because their real estate sector, which represents nearly 30% of their entire GDP, is in freefall. Ghost cities, unfinished projects, developers defaulting, banks holding worthless collateral. So what's the solution? Print, flood the system with liquidity, try to reflate the bubble before it collapses completely. It's the economic equivalent of trying to save a sinking ship by pumping water into the hull. The more you pump, the faster it sinks. But they have no choice, because if the real estate sector collapses, the banks collapse. If the banks collapse, the currency collapses. If the currency collapses, social stability collapses. So they print. And where does that newly created currency go? It doesn't sit in bank accounts, it flows into commodities, into assets that cannot be printed, into silver. That's why Shanghai is paying $111, while New York is stuck at $99. Chinese liquidity is chasing physical scarcity. Now let's cross the Pacific. United States, the issuer of the world's reserve currency. The Federal Reserve will tell you they're fighting inflation. They'll point to interest rate hikes. They'll reference quantitative tightening. They'll use technical language designed to confuse rather than clarify. But look at the actual data. Look at the government deficit, $2 trillion per year. During peacetime, with unemployment at historic lows, with the stock market at record highs, where's that $2 trillion coming from? Not from tax revenue, not from economic growth, from the printing press. Every dollar the government spends beyond what it collects in taxes is a dollar that must be created, and every newly created dollar dilutes the value of every existing dollar. This is theft by mathematics. Your savings account shows the same number, but that number buys less. Your paycheck shows the same amount, but that amount covers fewer expenses. The number stays constant, the value evaporates. And the beneficiaries of this theft? Wall Street. The newly printed money doesn't go to you. It goes to banks, to hedge funds, to institutions that use it to buy assets before the inflation reaches consumer prices. By the time you feel the inflation at the grocery store, they've already front-run the entire economy. This is the mechanism behind the everything rally. Stocks aren't rising because profits are growing. They're rising because there's too much currency chasing too few shares. But if you think the United States and China are extreme cases, if you think this is just a problem for major economies, let me show you the future. Let me show you what happens when this process reaches its inevitable conclusion. Argentina, Turkey, Venezuela. In Argentina, the money supply expanded 70% in less than 12 months. 70% in 1 year. And what happened to their stock market? It went up. The Buenos Aires exchange showed impressive gains. Portfolio managers celebrated. Investors felt wealthy. But did the Argentine people get rich? No, they got destroyed. Because while stocks rose 50%, food costs rose 100%, rent rose 120%. Medical care became unaffordable. The nominal gains were an illusion, a mirage in the desert. You see water, but when you reach it, there's nothing there. Turkey followed the same path. The Borsa Istanbul became one of the best performing markets in the world. In lira terms, investors were geniuses. In real terms, they were being obliterated. A 60% gain in stocks meant nothing when bread cost twice as much and electricity was rationed. This is what economists call nominal versus real. Nominal, the number on the screen. Real, what that number can actually buy. And right now in the United States, in Europe, in every developed economy, the gap between nominal and real is widening. Your 401k shows growth. Your investment account shows profits. But your purchasing power, your ability to convert those paper gains into actual goods and services is declining. You're on a treadmill that's speeding up. You have to run faster and faster just to stay in the same place. And the treadmill is powered by the printing press. Every month, central banks create more currency. Every month, that currency dilutes your savings. Every month you fall further behind while your account balance rises. This is the liquidity trap, not the academic definition, the real definition. Too much money, too few goods. Prices exploding, values collapsing. And in the middle of this chaos, there's one price signal that cannot be manipulated. One asset that tells the truth while everything else lies. Silver. Silver isn't rising to $99 because of industrial demand, though demand is at record levels. Silver isn't rising because of investment enthusiasm, though investment has increased. Silver is rising because it takes 99 of your diluted, debased, depreciated dollars to buy the same ounce of metal that cost $20 just a few years ago. Silver is the thermometer, and the reading is 105 degrees. The patient has a fever, a dangerous, potentially fatal fever, but the doctors, the central bankers, the treasury officials, the financial media are telling you the fever is bullish. They're telling you rising temperatures mean health. They're telling you to celebrate the infection. Don't. Because this liquidity flood is creating distortions that go beyond stocks and commodities. It's breaking correlations that have existed for decades. It's creating market behavior that defies traditional analysis. And nowhere is this more visible, more confusing, more important, than in the strange silence of the asset that was supposed to be the savior. The digital gold, the hardest money ever created, Bitcoin. For 15 years, we've been told a story, a narrative so compelling, so logical, so inevitable, that it became gospel in financial circles. The story went like this. Gold is ancient, silver is industrial, but Bitcoin is the future. Digital gold, harder than gold itself, unforgeable, unseizable, transportable at the speed of light, the ultimate store of value for the digital age. And when the dollar finally collapses, when fiat currency breathes its last breath, Bitcoin will inherit the earth. That was the story. And for a decade and a half, the story held. Bitcoin survived regulatory attacks. It survived exchange collapses. It survived media ridicule and institutional skepticism. It went from $0 to $1,000 to $10,000 to $69,000. Every crisis strengthened it. Every monetary intervention validated it. Every round of quantitative easing sent it higher. The correlation was perfect. Money printing equals Bitcoin rising. Currency debasement equals Bitcoin adoption. It was mathematical, predictable, inevitable, until today. Until January 23rd, 2026, the day the narrative broke. Look at the scoreboard right now. Gold, $4,035 per ounce, the highest price in 5,000 years of monetary history. Silver, 916 and climbing towards the Shanghai target of $111, breaking through resistance levels that have held since the 1980s. Stock market, vertical. Real estate, surging. Commodities, exploding. Everything with mass, everything with atoms, everything that exists in physical space is rising. And Bitcoin? Bitcoin is lagging. stumbling, acting like investors forgot it exists. Not crashing, not collapsing, just quiet, disturbingly quiet. In the middle of the greatest monetary crisis of our generation, in the middle of the exact scenario it was designed for, Bitcoin is underperforming a yellow rock and a white metal. Why? Because this isn't a speculative mania, this is a physical panic. And there's a profound difference. Speculative manias are driven by greed, by the fear of missing out, by the belief that numbers on a screen will keep going up forever. Physical panics are driven by survival instinct, by the ancient recognition that when systems collapse, when supply chains break, when currencies fail, you need things, real things, things you can hold, things you can see, things that have existed for longer than any government or institution. Let me be very clear about something. Bitcoin is mathematically scarce, Bitcoin is technologically sophisticated, Bitcoin is potentially revolutionary, but Bitcoin is not physical, and right now, physicality matters. You cannot build a solar panel with Bitcoin. You cannot manufacture a semiconductor with Bitcoin. You cannot create an EV battery with Bitcoin. You cannot load Bitcoin into a cruise missile or a fighter jet. Bitcoin is digital energy, an abstraction, a claim on future value. But silver? Silver is physical necessity. Silver conducts electricity better than any other element. Silver reflects light with near-perfect efficiency. Silver kills bacteria on contact. Silver is embedded in every major technology of the modern world. Medical devices, water purification, 5G infrastructure, military systems, green energy. When the world is worried about supply chains, when the world is watching geopolitical tensions escalate, when the world is preparing for potential conflict, the market doesn't reach for digital abstractions. It reaches for physical necessities. The smart money is making a calculated decision right now. They're looking at their portfolios. They're looking at the impossible signal. They're looking at stocks and gold rising together. And they're asking a simple question. What happens if this gets worse? What happens if the monetary system doesn't just weaken, but breaks? What happens if supply chains don't just slow down, but stop? What happens if the digital infrastructure we take for granted becomes unreliable? And when they run those scenarios, when they stress test their holdings against true crisis conditions, they're rotating out of digital and into physical, out of the cloud and into the earth, out of the intangible and into the tangible. This is not a rejection of Bitcoin. This is a recognition of reality. In a functioning global economy with stable currencies and reliable infrastructure, Bitcoin is superior, faster, cheaper, more divisible, more portable. But we are not in that world anymore. We are in a world where the impossible signal is flashing, where stocks and gold rise together, where central banks print trillions without consequence, where the reserve currency itself is in question. In that world, in this world, atoms beat bits, history beats innovation, 5,000 years of monetary evolution beats 15 years of digital experimentation. The market is voting with its capital, and the vote is clear. Physical assets are winning. But here's what makes this rotation truly dangerous for the paper markets. Here's what makes the current situation unsustainable. While Bitcoin is lagging, and while digital assets are taking a back seat, the physical market is setting a price that the paper market cannot ignore. We talked about it in part 1, the Shanghai premium, the $12.50 gap between New York and Shanghai. That gap is not closing, it's widening. And it is creating a magnetic force so powerful that it's about to rip the Western pricing system apart. Because here's the reality that every major bank is now facing. New York can print infinite paper contracts. New York can manipulate futures markets. New York can coordinate media narratives and margin requirements. But New York cannot print physical silver. And physical silver is flowing to Shanghai at 111.66, every ounce mined in Mexico, every bar refined in Switzerland. Every vault inventory in London is looking at two prices. Sell to New York for $90, sell to Shanghai for $111. The decision is automatic. The metal flows east, and this creates a death spiral for the short sellers. They need physical metal to cover their positions, but the physical metal is leaving, draining out of Western vaults, flowing to the highest bidder, and the highest bidder is 7,000 miles away. The paper price in New York is living on borrowed time. It cannot stay at $90 while the physical market trades at $111. The laws of arbitrage won't allow it. The mechanics of global trade won't permit it. Eventually, soon, perhaps tomorrow, perhaps this weekend, the paper price will simply gap up. It won't trade through $100, $101, $102. It will open at $110. It will teleport to meet the Shanghai price, because sellers will refuse to sell for anything less. Why would anyone sell physical silver in America today? Why would anyone accept $99 when they can get $111? It's financial suicide. This is called a seller's strike. And when it happens, when the paper market tries to open on Monday morning and discovers there are no sellers at $99, no sellers at $100, no sellers at $150, The price will simply jump. And the short sellers, the banksters who have defended this market for 40 years, will face their moment of reckoning: mathematical insolvency, forced liquidation, bankruptcy. The Shanghai price isn't just a premium, it's a target, a destination, an inevitable endpoint, and the Western market is being dragged toward it whether it wants to go or not. The physical preference has spoken. The market has chosen atoms over bits, tangibility over abstraction, history over innovation, and that choice, that fundamental shift in capital allocation, is about to reshape the entire financial system. The question is no longer whether silver breaks $100. Silver has already broken $100 in the real market. The question is when the paper market admits it, when the lie can no longer be sustained, when the facade finally collapses. And based on the data we're seeing, based on the flows we're tracking, based on the panic in the eyes of the short sellers, that moment is very close.